Chapter 12, Investing in Stocks. Here are this chapter's learning objectives. So there's two concerns for beginning investors: where to get the information and what the information means. Corporations issue common stock to finance their business startup costs and help pay for expansion and their ongoing business activities. We want you to learn how to evaluate stock and to make money from your investment decisions. So here's three important facts. While the almost 10% average annual return on stock investment described above is enticing, keep in mind that the value of stocks can also decrease. There is risk when you invest in stocks, and the key to success is allowing your investment to work for you over a long period of time. Corporations prefer selling common stock as a method of financing for several reasons: a form of equity, dividends not mandatory, and voting rights in the control of the company. Dividends keep stockholders happy. They are only paid from profits. If a company didn't have profits, there will be no dividends. Stock price is determined by how much a buyer is willing to pay. And here are some dividend indicators. Stock splits occur when the stock prices rise above an ideal price. Everyone that owns stock ends up owning more because of a split. Preferred stocks lack the growth potential of common stock and the safety of corporate bonds. When evaluating a stock, it's very important to recognize the difference between systematic risk and unsystematic risk. Systematic risk is risk associated with the economy. And then unsystematic risk is risk associated with the industry. Here's a table describing types of stock. Check out corporate websites or financial websites for up-to-date information. Here's a Yahoo Finance website. This is a great website that I personally go to. Professional advisory services can also help gather information about a stock. Newspapers can provide basic information as well. Here's an example. Common stock price quotes here. This would be off Yahoo Finance. Numerical measures that influence investment decisions. So corporate earnings. So if you see, and if you're looking up on Yahoo Finance, Coca-Cola stock, and it's showing that there is some corporate earnings. Positive equals good for corporate earnings. The more, the better. And then earnings per share will also be in there. If an earnings per share increased, then that's a good sign. So price earnings ratio, if the price earnings ratio is more than 20, that's a good sign as well. Projected earnings is a good sign if the projected earnings are projected to increase. Dividend yield. If there's a dividend yield increase, that's also a healthy sign. Beta. If a market has a beta of 1, that's good. So the higher the beta for stock is actually bad. So you want 1 or less for the beta. The book value per share, if the market price per share is often more than the book value. To purchase common or preferred stock, you must go through a financial advisor. Secondary markets would be like the New York Stock Exchange. I keep saying this over and over, but I would recommend that you go through a financial advisor, and then they will access the New York Stock Exchange for you. There's also an over-the-counter market, the NASDAQ. Again, I would suggest that you meet with a financial advisor if you've never invested before. So a financial advisor is a stockbroker. And then here it talks about churning. Churning is actually against the law, and it is monitored by the SEC. I can't think right off the top of my head what that means right now, the SEC. The stock, anyway, at some point I'll go over that with you. So churning is when you meet with an advisor and they use your money to keep buying new stock. If they do that and charge you every time they buy new stock, that's called churning, and that's not allowed. SEC, I believe it stands for the Securities Exchange Commission. Sorry about that. So here's a table showing when you should use a full service or discount brokerage firm. A discount brokerage firm would only be recommended if you really knew what you were doing with stock, with investing stock. Again, I would suggest a full service brokerage. All of us, including myself, should use a full service brokerage firm. Next, you can choose to buy or sell now or at a certain price. So if you have if you want to buy stock from Coca-Cola, you could say, well, right now, stock price for Coca-Cola is $25 a share. I want to wait till it goes down so that I can buy it a little cheaper because I know that it's going to go up for whatever reason. So you could put in an order to buy Coca-Cola stock when the price goes down to $23. So when you do that immediately, as soon as it goes down to $23 a share, you could buy the stock. The same with if you've already bought stock, you could put in an order. I'm noticing that the stock price is going down for Coca-Cola, and I want to put in an order to sell it as soon as it hits $23. So you could do that as well. Be sure to clarify all costs before investing. Long-term and short-term investment strategies. So here's some long-term investment strategies. Buy and hold. So you buy stock and you just hold on to it until you retire or until you're at that goal that you're trying to reach. Dollar cost averaging, you invest in equal dollar amounts over time. So again, let's go to Coca-Cola. Let's say you're really interested in investing in Coca-Cola. So every 2 weeks, you're going to have $100 taken out of your savings account and invest in Coca-Cola. Well, so sometimes you'll buy like 3.2 shares of stock or whatever the price is. So that's what dollar cost averaging is. Or DRIPS is reinvesting your dividends. So again, with Coca-Cola, if I bought Coca-Cola stock and they were paying me $1 dividend for every share, like every 3 months, I could say instead of me taking that $1, just use that $1 and reinvest it back in Coke. So there's no guarantees with buy and hold, but usually the most effective way to achieve growth. So dollar cost averaging, you just pick a certain dollar amount to choose every year or every month. And then the DRIPS provide an additional source of capital to corporations. So some corporations will suggest that you reinvest that dividend. Short-term investment strategies, they're risky unless you're very experienced. So here, I don't recommend you using these options at all. They're extremely risky. And that is it for this chapter. Thank you.